For Your Money is brought to you by NelsonCorp Wealth Management.
It's now time for Your Money. We're joined by David Nelson, CEO of NelsonCorp Wealth Management. Welcome back, David.
Thank you very much. Appreciate it.
Well, you've recently discussed shifts in some of 2021's big themes, such as higher inflation and rising interest rates. What are you looking at right now to keep on top of these changes?
Yeah, it's been significant. I mean, we're talking about decade-type highs as far as inflation expectations, and interest rates have really backed up. As far as backed up, meaning that they went up pretty significantly. Last year, if we look at it, the 10-year government bond was at 0.5%. This year, during the year, this is going back a few months now, we almost touched 2%, which is a huge increase as far as from where we were. So these are really important variables when we talk about people's monies and the impact that it can have. And certainly the expectation as far as inflation has come down. I brought along a nice visual here. That would be the 10-year Treasury yield. And what we see, and again, this is just looking at essentially a 12-month period of time, interest rates on the left-hand side of the chart in red were up there a little bit, and now we've come down to, we're at roughly 1.25% today. On the bottom, I think, is the more interesting one as far as that folks should be paying attention to. This is looking at what are called TIPS. These are an inflation adjusted a bond. And what we see there is that we're hitting all-time lows, meaning the interest rate that you receive and you factor in inflation, you're actually negative, and you're negative roughly 1.5%. This is not something that people want to have, and the negative 1.5% is very key to individuals' long-term success as far as trying to have positive returns.
Okay, so are low real yields a good thing, a bad thing, or does it make a difference at all?
Yeah, it's going to depend on if you're a borrower, you're digging as far as where we are right now. Interest rates have come down significantly. You know, mortgage rates look fantastic. But if you own CDs and you own bonds, it's pretty slim pickings right now as far as the ability to generate cash flow from those to supplement your retirement.
So what investment decisions are impacted by these dynamics?
I think the biggest thing is that individuals have been forced into investing their money instead of saving their money. And individuals need to be well aware as far as the risk between a government type bond and a corporate bond. A corporate bond obviously pays higher than a government bond, but it comes with a lot more risk. So people need to be well aware of that as far as the to their future ability to generate income.
All right. Well, David, thanks for your time. Always great advice.